In this video, we'll explain the accounting and amortization for unexpected gains and losses related to pension benefit obligations and pension plan assets. Unexpected swings in pension expense can result from sudden and large changes in the fair value of plan assets, which result in gains and losses which impact both pension expense and reported earnings. So do changes in the actuarial assumptions that affect the amount of the projected benefit obligation. The question then is, how can we try to mitigate the impact of this volatility on pension expense as well as reported earnings? The profession has decided to reduce this volatility with smoothing techniques. Companies use expected return on plan assets to calculate pension expense rather than actual pension plan returns. Companies record the unexpected gains and losses on plan assets, that is, the difference between actual and expected returns, as part of other comprehensive income and combine them with gains and losses accumulated in prior years. This treatment is similar to our accounting for unrealized gains and losses on available for sale marketable securities that are carried at their fair market value, but unrealized gains and losses aren't reported on the income statement. Rather, they become a separate component of other comprehensive income in the stockholders' equity section of the balance sheet. Unexpected gains and losses can also arise on pension liabilities. Pension benefit obligations are based on actuarial projections, which are assumptions, and seldom do these projections coincide exactly with actual experience. Changes to actuarial projections can result in unexpected gains or losses related to this projected benefit obligation. These are called liability gains and losses. Unexpected decreases in the pension benefit obligation will result in gains, while unexpected increases in the pension obligation will result in losses. These gains and losses are included in other comprehensive income, as are unexpected gains and losses on our pension plan assets. The question then is, what do we do with these gains and losses and other comprehensive income? The FSAB has adopted an amortization approach using a corridor. When unrealized gains and losses in the accumulated other comprehensive income get too large, the FASB uses a corridor approach to amortize the accumulated net gain or loss. The question then is, how large is too large? Too large is when the accumulated other comprehensive income, gain or loss, is larger than 10% of the beginning projected benefit obligation balance, or 10% of the fair market value of plan assets. Any excess accumulated other comprehensive income will be amortized using a remaining service life approach. This diagram illustrates the corridor. Again, we select the larger of our pension benefit obligation or pension plan assets, and of course that balance changes over time. We then take 10% of that balance. In the year 2019, 10% of the larger of the two numbers was $100,000. In 2020, 10% of the larger of the pension benefit obligation or pension plan assets was $120,000. In 2021, it's $170,000. Thus, if we have accumulated other comprehensive income greater than $100,000 in 2019, or losses greater than $100,000 in 2019, we would take that excess and amortize it over the remaining service life. Let's go ahead and take a look at a problem that involves gains and losses on pension plan assets and increases in our pension benefit obligation related to changes in actuarial assumptions. In this worksheet, we're going to consider a situation where our actual return on pension plan assets is different than our expected return on pension plan assets, And in addition, we're going to have an unexpected loss from changes in our pension benefit obligation due to changes in our actuarial projections. The Sandhill Corporation sponsors a defined benefit pension plan for its employees, and on January 1, 2018 had the following balances. Again, these are our beginning balances. We have plan assets of $498,300, a projected benefit obligation of $614,700, which of course gives us an unfunded pension liability of $116,400, and we're told that we have accumulated other comprehensive income related to prior service cost of $96,900. Let's begin by picking up these numbers on our pension worksheet. Our other comprehensive prior service cost is $96,900. We have projected benefit obligations, our liability of $614,700. Plan assets of $498,300, which gives us a net pension liability of $116,400. Again, our pension plan is underfunded. Let's begin by picking up now some of the information for the current year. We are told that our service cost is $92,500. Recall, this is the present value of future benefits that employees have earned during the current period. Notice this increases our pension benefit obligation. Next, we're told that the actual interest rate, the settlement rate is 9%, and we use that in our beginning pension balance of $614,700 to calculate our interest cost, and our interest of cost increases our pension benefit obligation. Next, we're given an actual return of $54,200. Notice our actual return increases plan assets. Plan assets are recorded and tracked at their fair market value. We are also, told that we record pension expense for the period using expected returns. So we will deduct the unrealized gain of $3,000. This will result in a net pension expense of $51,200 as it relates to our return on plan assets. So we reduce the pension expense by the amount of the unexpected gain, and we record that as part of other comprehensive assets. And the unexpected gain reduces our current pension expense but increases equity with a $3,000 credit to other comprehensive income. Next, we're going to pick up the amortization of our prior service cost, which we were told was $18,100. We will debit our pension expense, and we credit or reduce our OCI related to our prior service cost. Next, we are told that we have an unexpected loss from our change in our pension benefit obligation. In other words, our pension benefit obligation has gone up by $74,200. Recall, we don't record this loss as an expense in the current period, but rather we record it as part of other comprehensive income. Next, we are told that we make a contribution of $97,200. This will reduce the company's cash, and it increases pension plan assets. Finally, we're told that benefits that are paid to retirees are $82,600. The benefits paid reduce our pension obligation, and since they're paid from pension plan assets, they reduce the plan assets by the same amount. We're now ready to calculate our pension expense for the year. Our pension expense for the year is $114,723. It is our service cost of $92,000, our interest cost of $55,323, our unexpected loss of $3,000, or rather we deduct the unexpected gain of $3,000, and we increase it by the amount of the actual pension return of 54, and then we subtract or include as the expense the 18,100. So we've got our debits less our $54,200 credit. Gives us 114,723, and we record that as pension expense. Next, we flip the cash. We had credits to cash of $97,200. We calculate the change in our other comprehensive income for the year, and that was the amortization of the prior period's service cost, and we credit other comprehensive income. Next, we pick up the change in current year's other comprehensive income related to the gains and losses on pension assets, as well as the gains and losses related to the change in our projected benefit obligation. We have the $74,000 credit and the $3,000 debit for a net change of $71,200, and we pick that up in our journal entry. Finally, we pick up the pension liability, and that pension liability is the plug that makes our journal entry balance, and we should see that it is the difference between our ending pension benefit obligation and our ending plan assets. Totaling up our columns, our current balance at the end of the year for the other comprehensive income is $78,800. We have other comprehensive income related to gains and losses on our pension plan assets and changes in pension benefit obligations of $71,200. And we're going to check and make sure that our pension plan assets and projected benefit obligation tie in with our net pension liability. Our pension plan assets, we take our beginning balance of $498,300, add to it our $54,200 actual return. We add to it our contribution of $97,200, and of course we deduct the benefits paid of $82,600. For our pension obligation, we have the beginning balance of $614,000. We add to it the current period service cost of $92,500, as well as our interest cost of $55,323. We record the $74,200 increase in our pension benefit obligation due to changes in our actuarial assumptions. And then last, we subtract the $82,600 in benefits paid.